completely awesome this week as well. Let's get in a special guest on the show today. Edelweiss Aditya Narain, Head of Research, Head of Strategy, and some of us who've been following his work for a very long time, strategy work for a very long time, look forward to these kind of discussions with him. Aditya, good afternoon and thank you very much for your time. For a change, we will not immediately talk about markets, but would like to understand from you what are the signs you are reading when you talk to corporates which you have under coverage across spectrum, and also join the dots with the macro high frequency indicators. Everybody's talking about market moving ahead of reality, but how much is the mismatch? What's your observation right now?
See, I think everyone is trying to correlate the economy with the market, and they might just be running different trajectories, right? So I think to that extent, this correlation, running ahead, running behind, big gap between the two is probably a little is probably a forced comparison, right? I think if you were to look at it from a pure economy perspective, which is what corporates are reporting, which is what which is the commentary that is coming out from corporates, I think what you're clearly seeing is firstly a sense of relief for them that May has looked better than April and June has looked better than May, and there is a reasonable amount of optimism that the supply side has now more or less come back on stream. We have to watch more carefully as far as the demand side is concerned. So I'd say at one level,
Right. I think we lost Aditya there. We'll just get him back in a moment. That's a technical glitch over there. He was making a point, India strategy report from Edelweiss this time, and he was also making a point that the tight correlation between the state of the market and the condition of the economy may actually there would be a weak correlation. We need to see beyond that. Aditya, we have you back. Please continue your point. We lost him again. We'll just come back in a second. It won't take more than 10 seconds. So I was telling you that Edelweiss believes that market mood notwithstanding, demand aggregates are still appearing a little challenging right now. We'll talk to him a little more about that, and he is overall cautious on the market. But what's happening in the market? Market is all right. Before we get him, let's get a view from global guru Mark Faber, who we had earlier on the channel, what he believes of the investing environment, and we'll sort that technical issue and come back in a moment.
In 1999 and 2002, 2003, commodities had been in the bear market essentially since the 70s, in the case of precious metals, since 1980. So in other words, a 20 years bear market. Now, we had a bull market until 2008 for oil, and for gold and silver until 2011, and for agricultural commodities a little bit differently. But basically, after 2011, commodities didn't perform well. So we've been in a bear market essentially until, in the case of precious metals, December 2015. After 2015, gold and silver have done well, but they just made recently new highs in the case of gold, and in the case of silver, it hasn't made a new high yet. So I can say precious metals are relatively inexpensive. What is really very depressed are agricultural commodities and industrial commodities, whereby if you take lumber as an example, you could say it's some kind of an industrial commodity, and that has gone ballistic recently. It's got up a lot. But to answer your general question, of course, if the Federal Reserve and other central banks are printing money, the value of money, in other words, the purchasing power, will diminish. That is not difficult to see. You print money and you print money, and so the value of this excess liquidity makes paper money lose its purchasing power.
Right, Aditya is back with us. Aditya, tell us the point which you were making regarding the environment, the demand environment and earnings.
So as I was saying, from a demand perspective, people have looked at supply, and what you're looking out to is demand and how it plays through. And I'd say companies are relatively moderate as far as that. They are being cautious. They have not been very aggressive with guidance, and quite honestly, I don't think they know better. But I think that's where the crux of it entirely lies, which is what is going to be the kind of shape of demand that you get, right? I think there's been a big fixation in trying to get the level of demand. I think that's hard to call. I think the drivers of demand is what one should try and focus on. And I think at that point in time, I think there are certain calls that you can make in terms of the nature of demand that you can expect, right? I think your other part was in terms of markets and the fact that they seem to be elevated, particularly relative to the state of the economy. I think to some extent that one is a global phenomenon. B, it is a function of the amount of money that has been printed by banks and by governments. And to some extent, I think that is going to be a certain level of support as far as markets in general are concerned, simply because of the extent of money that is being pumped into the system. So I think trying to force feed the correlation between the economy and the market at this point in time, I think is a little strained. There will be a disconnect, but I don't think one should necessarily make too much out of it. There are, somewhat independent drivers out there. At some level, they have to coalesce, but maybe it's a little early in the game for that.
Aditya, in such a setup which you're talking about, and with stock prices in many cases already run up for good or bad, justifying the valuation or not, how should one go about designing the portfolio? What's your own construct of the portfolio right now? How to go about it?
Yeah, so what we are really looking at is, one is we have this hypothesis that there are going to be shapers of demand depending on events that have effectively played through at this point in time. And then we have themes that are coming out of them. And I think that's the way we think we should be driving the portfolio that we run with, or that we would suggest, right? And I think there are basically 5 themes that I find interesting, right? The first is structural over recovery, right? Because I think where you're seeing structural shifts, they're easy to play. You're more comfortable getting overvalued, as it were, in a conventional sense. And you don't run the risk that if the recovery is slower, you see a massive drop off that tends to happen, right? The second is really what I would say need over want. I think the one deflation that is fundamentally happening is in terms of incomes for individuals. And so you will end up seeing a need over want scenario, which is basically the safer place to play. So just in terms of playing too much discretionary, because I think it is safety first in terms of how spends will tend to happen. I think the third trend, which is I think critical in the way we are designing our portfolio, is the belief that businesses will be able to structurally cut costs very sharply. I think we've seen some of that in the first quarter numbers that have come through. I would tend to believe that is something that's going to get extended. And the way I would play it is that you prefer
Eicher and Hero Motor. Let's hear them out.
Situation in parts of Tamil Nadu affected the supplies from our own supplies to our dealers, and also we got affected by supplies from vendors availability of workers, then it impacted our production. It's picking up, and of late with improvement in supply chain situation, we're doing about 1,800 a day. We could do more. We certainly have the demand if we could do more. We have nearly 40,000 bookings that are still pending. So we're quite excited on the demand side, little bit frustrated and anxious on the production side, but I think things will get better sooner or later.
This is a quarter which is being built from the start with with large part of the quarter which was under lockdown. I think what will help is which we have said is that if we take the lockdown period cost, fixed cost, when their operations were not existing, and you remember in our March 31st call we had talked about our lockdown period cost being around 200 crores per month. We have assessed what our lockdown period cost was, because in April was entirely closed, May was partially closed, and then June is when we came back to 70-80% of the normalcy. If you add around 250 crores to the EBITDA numbers, which is the lockdown period cost, so because that period did not have any revenue, so if you actually add that back, then you get a EBITDA margin of 12% for quarter one. So I think that would have been a more comparable margin for quarter one than what you see the numbers, because those numbers are based on a truncated quarter where you have the fixed cost for the entire quarter, but revenue which is only for a very brief period. So I think that's basically as far as one can go with the ratios for this quarter.
Aditya, as you were saying that case to be cautious on discretionary, some part of it was reflective in the cautious to mildly positive commentary from Hero and Aisha. Let's talk about one area of the market. You track global macros quite closely as well. What are you making of the way commodity stocks have started rallying a whole lot? Not only traditional metals but soft commodities also. Is it a reopening trade playing out? How would you look at the global cyclicals stocks right now? What's your approach?
One of our bigger emphasis on the portfolio, and particularly the way we've revised it over the last couple of weeks, is actually to have a much greater bias for global cyclicals than we have for either domestic cyclicals or domestic consumption, right? And the reason there is simply two reasons, particularly on a relative basis. The first is the amount of money that's been put in by fiscal authorities. The second is the central banks, how much liquidity they've pumped in. And the third thing, and very importantly, the lockdowns have been less extreme as relative to India. So I think on all those counts, while one doesn't have a very clear picture of what will happen from a medium to long-term perspective, in the nearer term, it is actually going to inflate some of those demands, some of those price levels, and therefore some of those businesses. So we've actually taken in our model portfolio a distinct overweight view on global cyclicals, so things like metals and commodities, including soft commodities. But we've also taken a pretty aggressive call as far as some of these Indian businesses which are catering heavily to global markets, where the export ability and momentum can be quite large. So from our perspective, the relative pump priming of global markets is something that's going to drive their economic recoveries quicker. And so from the near to medium term, it is an area of portfolio weightage that you should actually look at overweighting. Medium term, once inflation starts rising and there are other challenges or they start getting pulled back, you'll need to keep an eye on that. But I think that is a later day issue that one shouldn't be, confusing oneself with at this point in time.
Right. In fact, in your report, you make a point that one of the reasons why market may appear expensive, but relative to money supply, it may remain, it may actually be on the lower side. Also, do you think that the factor that almost 40% of our benchmark earnings also come from abroad, so in a way that may also play out? Is that a correct way of look at it?
At some level, yes, right? And you clearly design your portfolio for stuff like that. The fact that there is a relatively large share of earnings coming in from the global side, that is a little bit of a hedge for overall earnings if you really look at it. The thing to keep in mind, of course, is some of those commodity elements are also input costs out here. So 40% wouldn't be the net impact. It would probably be a little lower. But to the extent that you have foreign earnings, you should skew yourself towards that end. And you're already seeing it in a lot of the data as far as global economies are concerned. It is stronger than what you're seeing from an India perspective.
Aditya, let's take a step back, in a little more bigger trend which is also emerging. Just today we had, Mark Faber talk about how post-COVID, a lot of professionals, skilled professionals who don't really need to be in the middle of congested cities, and their skill and knowledge can be, put out in the system even if they live in the countryside. This is a big global shift which is likely to take place, and people will shift out of that smaller, apartments in mega cities towards much more open, greener areas in the countryside. Here back home in India too, when one talks to a lot of people have gone back to their homelands and are saying that they can, some of them are fund managers in fact, you'll be surprised. These guys are saying we can manage a portfolio from there at least for the next 6, 8, 10 months and the organizations are okay. How do you think this will actually play out in terms of real economy is concerned? People going back to smaller towns and not coming back for a prolonged period of time.
So I think fundamentally it's a positive. It brings about more efficiency. It removes some of the inefficiencies in our day-to-day lives, whether it is travel, whether it is housing, right? I think it will do two distinct things, right? One is it will improve the supply of people, particularly for businesses like IT and all, where you suddenly open up a much wider market, and so you can effectively pay a lot less, right? So I think in that sense it is critical, and something like an IT business actually is going to be a massive beneficiary from it, right? But I don't think that from an India perspective, that will be adequate to change the trajectory of growth, firstly. Secondly, or the fact that cities no longer are the engines of growth. I do believe that in a place like India, in a country like India, you will still need the hustle and the bustle of cities. You will need the day-to-day economic activity that cities provide and the extra job creation that they provide, right? So I think clearly it is a positive. Some businesses will benefit more from it. Individuals, some of them will benefit a lot more from it. But can it, stop this influx of people into cities or the dependence on cities to generate the bulk of your growth? I don't think that will change radically,
Aditya, one point niggling fear of the market or concern of the market is the way consumer inflation has shot up to almost nudging the 7% mark once again. Some say dimming hopes of rate cut in the near term. The bond yields have also responded. Is that an issue, or do you think it's a temporary and again it will actually taper off and some more rate cut possibility? Because last 2-3 months at least, lower rates did start to go transmitting into the real economy.
See, I think it does impact the policy making dynamic. You have already seen that with the last policy where rates were held and not cut, right? But if you actually step beyond, quite honestly, I think the problem and the issue with the economy is going to be demand. It's not going to be supply, right? And so to that extent, I think it hurts the overall recovery of the economy that rates cannot come down because inflation is a little high, and policy makers, in our case, are going to be a little bit more watchful with it. But I don't believe that you're going to have inflation at these levels, or even 4 or 5 levels for any sustainable period of time, simply because it's not a demand-full scenario. Supply side in India gets restricted, but only for short periods of time. And so to that extent, I think it does delay stuff. We've seen it from a policy response. But in terms of underlying demand-full inflation, I think it clearly is not that. Demand is the lack of demand is the problem, not excess demand. And so to that extent, this will normalize, and it needs to normalize quicker than otherwise, because the longer it takes, the greater is the setback as far as recovery is concerned. If you were to look at India's interest rate structure over the last 5 years, I think the missteps that have happened have been that we have been too tight for too long at different points in time, because inflation has spiked up temporarily because of food prices, right? I think we should try and move away from that. The sharper and the more smooth is not a big risk in this economy, and I don't think that will be the case for a fairly long period of time. So it does hurt the trajectory of recovery, and I wish that were not the case, because it does pull back stuff a little bit.
Quickly, Aditya, right, all right, Aditya, we'll let you go on that one, completely out of time. Thanks very much for your time, and great having you. That was Aditya Narain of Edelweiss. Let's get in my colleague Abhimanyu to talk about what's the latest as far as the AGR issue is concerned. Telecom clearly has been in focus.